Hi, good morning, good evening, depends on where you are. This is my dear Vice President and the Senior Fellow at the Center for China and Globalization. It is my great pleasure to welcome all of you to join us for the Global Economic Perspective Report official launch. This has been 6 times for CCG in partnership with the World Bank Group to launch this very important report. As we start the new year 2023, and we have seen lots of positive signs as we put some start to the pandemic after 3 years. So at the same time, we have seen quite a number of concerning factors in the economies as well as in the business, as we see a much more high inflation, high interest rate, and everybody is holding tight on the pockets. As we start the whole thing, and also we would like to, welcome a distinguished guest from the World Bank Group. So this morning, Regional Director for East Asia and the Pacific, Dr. Chief Economics and Director, World Bank Prospects Group, and also Sebastian Eckert, World Bank Practice Manager for Microeconomics, Trade and Investment in East Asia and the Pacific region. So we're going to start this whole year with this very exciting report. Economics Perspective Report is a World Bank Group flagship report on global economics development, published semiannually. It focuses on emerging markets and developing economy, presenting in-depth issues in the global and the regional economics. Without any further ado, I would like to invite Hassan Zana to give us some opening remarks. Hassan, the floor is yours.
Thank you very much, Mr. Liu Hong. It is really an honor to be here and continue our partnership with the Center for China and Globalization in the launch of the Global Economic Prospects and also contribute to the conversation on China's economic prospects and our views on that during this conversation. I will keep my opening remarks extremely short because I know that everybody really here is interested in listening to these presentations. I'll just introduce my colleagues to say that Dr. Ayan Kose is the Chief Economist of the Equitable Growth Finance and Institutions part of the World Bank and Director of our Global Economic Prospects team. And he will present on the overall sort of themes of this report, which is always exciting and gets a lot of coverage and is really our flagship publication on economic issues. Sebastian will focus on China. He will no doubt in his presentation explain the rationale for our growth forecast, which of course we think through, but we arrive at knowing with a lot of humility, knowing that there is quite a bit of uncertainty in the outlook, especially with the uncertainties around the global economy and how the pandemic sort of profile will turn out in China next year. We are currently projecting in the mid-4s, and I'm sure he will explain that and the rationale for that. During the discussion, I would also be happy to come in and participate in a conversation about how the rest of Asia looks in terms of its economic prospects. And I'll be joined by my colleague Ekaterina Vashakamande, who will also participate, and she's a core member of the Global Economic Prospects team and the Asia Department team as well. With that, Thank you. It's really an honor to be part of this. And let me pass it on to Ayan to get us started. Thank you very much.
Thank you.
Thank you, Mike, and thank you, Hassan. Mike, let me thank Center for China and Globalization. It's such a wonderful partnership, and I'm very happy we are doing it once again. It's becoming a tradition to exchange views on the state of the global economy, China and the broader East Asia and Pacific. We released a report last week. I'm going to show a few slides today to give a kind of a big picture idea what we try to achieve in the report. The report has the usual global outlook and regional outlooks. The regions we are, of course, focusing on at the World Bank and mainly emerging market and developing economies. In addition, there are two analytical chapters in this edition of Global Economic Prospects. The first one looks at investment growth in emerging market developing economies and how weak it has been over the past 2 decades, especially after the pandemic. And then the second chapter looks at the challenges confronting small states, those countries, population 1.5 million and less. And of course, a number of these small states are in the Pacific, small island nations. What I'm going to do, I'm going to focus on 3 questions. The first one, what are near-term prospects for the global economy? The second one, how have overlapping global crises affected small states? And the third one, what are the policy priorities? Throughout the presentation, I'm going to use this acronym, EMDs, that stands for Emerging Market and Developing Economies. Let me start with the first question. What are near-term prospects for the global economy? Over the past 12 months, global economy has been buffeted with a wide range of shocks. The first shock, of course, the legacies of the pandemic and how that has been affecting quantities in terms of production and as well as prices. The second one is the elevated inflation and a sharp increase in interest rates. The third one, of course, the volatility in commodity markets, and that volatility is associated with in part with the Russian invasion of Ukraine. Against this background, we downgraded our growth forecast significantly for 2023. We are now expecting growth this year to be around 1.7%. This is 1.3 percentage points lower than what we expected in June. It's important to put this number in historical context. It is the third lowest growth rate since the early 1990s. The other two numbers, lower than this one, were associated with the 2009 global recession and 2020 global recession. In other words, the global economy is on a razor's edge, perilously close to falling into a recession. If any of these shocks we are going to discuss soon, the risks materializes, there is a high likelihood that we will see a global recession this year. We also downgraded growth forecasts in advanced economies significantly. Last year, these economies delivered growth around 2.5%. This year, that number will decline to 0.5%. And that's one of the lowest growth rates advanced economies delivering over the past 4 decades. Now, in the context of emerging market developing economies, growth, at least in the aggregate, appears to be stable, 3.4%, basically the same number we had last year. But this is entirely due to China's performance. We believe that China's growth is going to increase this year around 4.3% than what it delivered last year, slightly below 3%. But in the rest of emerging market developing economy group, when you take out China, growth is going to slow significantly from 3.8% to 2.7%. This is a very low number for these economies, even lower than the pre-pandemic average we saw, slightly above 3%, which we thought was quite weak. When you look at the regions, in all regions, growth forecasts were downgraded for this year. East Asia Pacific is going to deliver higher growth thanks to China's performance. I'm not going to get into the details of that one, as we have a presentation dedicated to China and the broader region. When you look at Europe and Central Asia, where the war takes place, growth is pretty much flat, around zero. If you take out Russia and Ukraine from the broader group average, aggregate, the growth slows down significantly. Sub-Saharan Africa will see slightly higher growth, but that's not going to be sufficient enough to cope with the challenges the region is facing. Now, I mentioned one of the analytical chapters in this edition of Global Economic Prospects report looks at investment in emerging market developing economies. Investment is central to delivering higher growth. Of course, growth is central to reduce inequality, reduce poverty, and make progress in broader development goals, including improving health and education systems. Prior to the pandemic, we already had a significant slowdown in investment growth, as you see on the left chart. It doesn't matter what group of countries you are looking at. It doesn't matter whether you basically include China or exclude China in the sample. Growth of investment declined significantly. It was around 10% over the period from 2001 to 2010, then declined around 5% over 2011 to 19. Then the pandemic came. About 70% emerging market developing economies experienced outright contraction in investment. Since then, investment has been recovering, but recovering very slowly. In fact, as you see in the middle panel, investment recovery has been much slower than what it took place after the global financial crisis. Our calculations suggest that cumulative investment expansion since 2020 over the forecast horizon up to 2024 would be around 15%. Over the same time period, from 2010 to 14, investment growth was around 50%. So going forward, we are expecting even weaker recovery in investment in emerging market developing economies, as well as if you look at emerging market developing economies excluding China. And this will basically magnify the types of development challenges we have. During the previous decade, emerging market developing economies enjoy a protracted period of friendly financing conditions. In the 2020s, for the rest of this decade, those financing conditions are not going to be with them. So generating investment is going to be even more difficult when they face larger borrowing costs, of course, the challenge of generating growth. This somber baseline comes with a wide range of risks, and these risks are interconnected. And the number one risk, inflation, is remaining persistent. We think that inflation will come down this year. Last year, we saw inflation around 7.6% globally. This year, that number will go down to 5.2%. But core inflation, inflation that excludes food and oil, energy prices, will likely remain elevated. And elevated enough, central bankers, especially in advanced economies, will continue increasing interest rates or keep interest rates elevated. With persistent inflation and elevated policy interest rates, financing conditions will remain tight, in all likelihood will get tighter. and that increases the likelihood of financial stress in an environment we have record high debt levels in many emerging market developing countries, especially in frontier markets and low-income countries. Another important risk we are monitoring is geopolitical tensions. Those tensions now have a history. Of course, that history has multiple dimensions in the context of trade. Now, the Russian invasion of Ukraine and the war-related tensions. Those tensions manifest themselves in highly volatile commodity prices and bring energy and food insecurity in advanced economies as well as in emerging market developing economies. When you have high inflation, when you have weak growth, when you have food insecurity, the likelihood of social tensions increases. COVID-19 outbreaks remain a risk, as we see now China is dealing with an outbreak, and hopefully it will overcome this outbreak sooner than later. In addition to these risks, we have risks associated with climate-related disasters, fragmentation of global trade, investment and financial networks, and over the medium and long run, weaker longer-term growth prospects and even larger development challenges. As I mentioned, the number one risk is the risk of persistent inflation. Inflation can come down, but can be sticky at a level higher than central banks' inflation targets. If that happens, central banks might have no choice but to increase interest rates even further. Nowadays, global policy interest rates are around 5%. In the report, we look at different scenarios, analyzing the consequences of further increases in policy interest rates. In one of these scenarios, we look at the possibility of interest rates going up to 6%, another 100 basis points higher than their current levels. If that happens, real short-term interest rates go above 1%. And of course, the real short-term policy interest rates have been negative for an extended period of time. And it will be the first time after this protracted period of accommodating financial conditions, we see positive real rates. If that happens, there will be a serious collapse in confidence, heightened financial stress, and weaker growth. Growth will go down around 0.6%. Per capita global growth will be around -0.3%. And that will mean a technical global recession. Now, as I mentioned, this is not our baseline. In the baseline, we see weaker growth, but at the same time, slowing inflation. What are these multiple global shocks implying for income and income of the poorest? Over the forecast horizon we have till 2024, given that we have first 3 years of the 2020s, 2020, 21, 22, we are able to look at the growth performance of the first half of 2020s and compare it with the previous decade. That comparison leads to a disappointing outcome. The first decade of 2020s will, in all likelihood, witness per capita income growth in all regions we monitor, lower than the average per capita income growth of the decade prior to the pandemic. And over the next 2 years, the income growth of countries with higher levels of poverty will be lower than those with lower levels of poverty. In other words, we will have greater difficulties in terms of convergence of emerging market developing economies to income levels of advanced countries, and we will see weaker growth in countries that need the growth the most. Let me turn to the second question. How have overlapping global crises affected small states? Now, as I mentioned at the beginning of the presentation, small states are those countries that have population 1.5 million and less. We are looking at 37 small states in this report. These are middle-income countries, emerging market, developing economies. There are a number of common features of small states, as much as the group of small states is quite heterogeneous. These common features make them extremely vulnerable to a wide range of shocks. And these shocks, in fact, hit them during the past 3 years and have the largest impact on this group of countries. The first common feature of small states is how open they are to trade when you compare them with emerging market developing economies, excluding this group. The second common feature is how much they rely on other countries for their food and fuel consumption. Of course, this specific feature made them quite vulnerable to consequences of the war in Ukraine. Many of these small states, especially those in Caribbean and the Pacific, are small island states. They rely on tourism revenues much more than a typical emerging market developing economy. During the pandemic, tourism collapsed, and the revenues of course, tourism collapsed as well. That was a big shock for small states. Another important feature of these countries, they are geographically remote, especially those in the Pacific, than from centers of commerce. So when you put all of these common features and vulnerabilities, something remarkable happened over the past 3 years. During the pandemic, these economies were hit hard. They contracted more than 11%, 7 times larger contraction than typical emerging market developing economy. Since then, recovery has been very slow. As financing conditions have gotten tighter, these economies, that problem also became a bigger burden to carry. Of course, during the pandemic, they needed to borrow more to close the holes, and they even added a larger stock to the existing stock of debt. Now, for the first time this year, we are expecting small states to get back to pre-pandemic level of GDP. This happened in the first year after the pandemic in emerging market developing economies. So the challenges small states are facing quite sizable. They are like canaries in the coal mine. They tell us the magnitude of the impact of these overlapping crises and what can happen next when, of course, other types of crises hit. One of the important vulnerabilities of the small states is their sensitivity to climate-related disasters. Now, when you look at the policy priorities and the structural challenges emerging market developing economies facing, there is a large cost of climate-related natural disasters. This large cost manifests itself very visibly in the case of small states. For example, Caribbean small states paid around 6% of their GDP when they faced these types of natural disasters over the past 4 decades. Now, of course, this challenge associated with natural disasters, given the limited capacity of these countries, magnified, since they are unable to simply respond to these types of frequent and costly shocks. Prior to the pandemic, food insecurity was a problem. And when you look at low-income countries, give and take around 50 million people were suffering from food insecurity. Now, last year, that number went up to 110 million, just in low-income countries. Many of these low-income countries are fragile conflict states. But the magnitude of the problem requires serious and bold intervention. During the pandemic, another big problem became even larger. Prior to the pandemic, we thought that there was a learning crisis. That learning crisis intensified with the school closures and ability of the kids to acquire the type of education they typically acquire. Now, what countries can do in an environment with limited policy space? Every crisis presents an opportunity. In the context of this crisis, finding ways to facilitate trade, reduce the cost of trade across borders, improve customs and regulations, and digitize the types of factors that impede trade, going to be critical. I mentioned investment weakness. There is a wide range of reforms countries can undertake to improve investment climates, improving institutions, improving private property rights, improving legal systems, improving overall business climates to attract more foreign direct investment and providing incentives to local entrepreneurs. Countries, they deliver these types of sustained investment reforms, saw significant increase in investment. And those countries, they ended up seeing setbacks when it comes to investment climates, suffered larger declines in investment. Another important reform agenda should be on domestic revenue mobilization. Revenue collection, as much as it has increased over the past 2 decades, still remains lower relative to GDP in emerging market developing economies and low-income countries. This is another important reform agenda for them to push in an environment fiscal space remains limited. Now, when we think about policy priorities, there are certain policy challenges we need to address at the global level. Of course, that starts with mitigating the risk of global recession by implementing transparent, consistent, and credible policies. There is a very serious debt problem, especially in frontier markets and low-income countries. We need to have a better, faster, more robust framework to address the debt challenges these economies are facing. And of course, we need to coordinate better to reduce food insecurity. At the national level, we need to avoid protectionist measures. They are not helping, they are hurting, and they are magnifying the problem as they increase the cost of food at the global level. Climate challenge remains a major issue, and there is greater recognition now to address this problem with larger resources by the global community, and we need to intensify that reform agenda in the context of climate and find those resources, channel those resources, and push infrastructure projects on the ground to address the climate challenge. Now, at the national level, everything starts with policymakers taking care of their houses and making sure that their houses are in order, meaning domestic policy agenda set on strong foundations to address weaker investment growth and basically improve policy frameworks in the context of fiscal policy, in the context of monetary policy, and in the context of financial policies. I mentioned small states. There are interventions these small states can undertake as well as interventions at the global level, international community has to push through. Small states can push diversification through digitalization, reducing trade costs, and fostering new industries, including ecotourism, investing in climate adaptation, and domestic renewable energy sources going to be critical for small states. State-owned enterprises will require more discipline, and establishing fiscal mechanism, fiscal rules, disaster stabilization funds to enhance disaster risk management going to be critical. At the global level, there has to be larger resources allocated to address the challenges confronting small states, especially in the context of climate change. Let me summarize what I said. First question I asked, what are near-term prospects for the global economy? We are going to see the weakest growth performance outside global recessions of the past 3 decades. There is a serious investment slowdown, and that slowdown is coming on the heels of a decade of subdued investment in the 2010s. And multiple downside risks cloud the outlook. Second question, how have overlapping global crises affected small states? These economies suffered a far more severe recession during the pandemic and now experiencing a much weaker recovery than other emerging market developing economies. And the third question, what are the policy priorities? At the global level, we need to cooperate to address universal challenges we are facing, including climate change, food insecurity, and debt distress. At the national level, we need to implement credible policies to contain inflation, ensure macroeconomic and financial stability, and set the foundations for a green, resilient, and inclusive development path. Let me invite all of you to visit our webpage to check other publications on global macroeconomic challenges. Thank you, and back to you, Mike.
Thank you so much, Dr. Han Kosi, for an excellent perspective. I look at in the 2023, lots of challenges still ahead of us. If you look at, as you beautifully summarize, in the near term, lots of uncertainty, and the investment is slowing down. And also I capture a number of key figures as you walk us through. Even if I look at in the emerging market, without China, the growth in 2023 will be 2.7. With China, they will be back to 3.4, right? So I think it is very important to really take a deep dive into 2023, how China is well performed, and what the uncertainty, how we are able to navigate through these uncertainties. So without any further ado, I would like to invite Sebastian and Carter, World Bank Practice Manager for Macroeconomics, Trade and Investment East Asia and the Pacific region, to deliver second feature presentation, China in 2023, Navigating Uncertainty. Without any further ado, let's invite Sebastian. The floor is yours.
Thank you very much, Mike, and let me reiterate also my personal gratitude for the opportunity to share with you the outlook on the Chinese economy. As you mentioned, against the backdrop of a very challenging global economic outlook, China indeed stands out as the only major economy expected to recover and actually accelerate this year. Now, in my short presentation, I want to touch upon 3 broad messages. The first message is looking back a little bit to last year, basically because it determines the starting point. And of course, if we look at last year, China's economy slowed sharply, and that was due to several mostly domestic headwinds, and I will talk a little bit about that. Then secondly, I want to talk about the near-term outlook especially for 2023. And as mentioned, we expect China's economy to recover in 2023. And in our view, that's supported by a broad growth policy pivot where several macroeconomic, but also public health and regulatory policies are expected to provide a boost to a recovery of the domestic economy. And then finally, I will conclude also with some policy implications, focusing both on near-term policies to essentially solidify the expected recovery, but then also talk a bit about medium-term policies to help rebalance China's economy and set it on a sustainable medium-term path. So let's start with 2022. If we look at the growth dynamics last year, what we see is that there was a bit of a stop and go economic performance, in large part driven by the dynamics of the pandemic, where we saw recurrent outbreaks that then in turn caused the imposition of restrictions, localized restrictions on mobility, which in turn led to dampened economic activity, and those slowdowns were then followed by uneven recoveries. For the whole year, we expect growth to have slowed to 2.7%. Last year, actually, in fact, coincidentally, in last year's GDP growth number will be released today, so we'll see where we ended up. But market forecasts widely expect growth to have slowed to below 3% last year. Now, if we look at what's driving that, in effect, we see that especially domestic demand, both investment and consumption slowed markedly last year, and it was only partially offset by relatively resilient export performance, at least for most part of the year. Also, we see that in the last quarter, exports weakened substantially, foreshadowing basically the slowdown in the global economy and weaker external demand, as mentioned by Ayhan in his presentation. Now, in addition to the impact of the COVID pandemic and measures to contain it for most part of the year, the other big story in China is, of course, the slowdown in the property sector. China's housing market has been embroiled in essentially a liquidity squeeze, which in turn caused financial distress among developers, which in turn eroded confidence by home buyers, which weighed on real sector activity in that important sector that is estimated to contribute about a quarter of China's GDP directly and indirectly. And what I'm showing here is some key indicators for last year, and we can see that investment has fallen and contracted sharply in the sector, contributing or weighing, dragging down overall investment in the economy, despite infrastructure investment offsetting this to some extent. We see that essentially sales are down, and so is revenue. So in a sense, the sector has really been in a slump last year. Now, as I move to the outlook later in this presentation, of course, our expectation and market expectation is that, in a sense, the slowdown has hopefully bottomed out, and we expect some recovery next year. Now, offsetting the weakness on the domestic side, as I mentioned, we did see a positive export or quite resilient export growth for most part of the year. But importantly, if we focus on the near term and the forward look into this year, we see that exports have slowed markedly in basically starting in November, in line with what we see globally, where we see a major downturn in trade activity and soft demand. For example, export orders have softened significantly, not just here in China, but elsewhere. And that was compounded to some extent by the supply side, where again, because of pandemic situation, some disruptions also occurred there. Now, if we look at the whole year, so we do see that net exports contributed positively to growth, and that we, of course, see the mirror image of that in a widening current account surplus, which contributed positively to growth last year. Now, moving beyond real sector and growth dynamics, what is interesting in China's case, and again, China is perhaps a case in point for the broader region in East Asia and the Pacific, we haven't seen the same sort of inflationary pressures that many of the other major economies experienced, with especially core inflation remaining below 1%. Headline inflation has picked up a little bit in the last quarter of the year on higher food prices, but overall inflationary pressures seem to remain relatively contained. Inflation expectations seem to be well anchored. Now, of course, this is something that needs to be watched now that we expect a recovery in domestic demand, but at least so far, China to some extent has defied the global inflation trend. Associated with the slowdown and the relatively weak economic activity, we also see that labor market pressures have persisted throughout the year, especially youth employment remains very high, partly because, as you can see from the right-hand chart here, job creation has slowed down markedly in the last 3 years. It's actually gross job creation, so just the sheer number of jobs created, have fallen below the official government target, and net job creation, which basically is the difference between new jobs created and jobs lost, have declined significantly. And that, of course, in turn has made it very challenging for new labor market entrants, graduates, to find employment. And as a result, this has received quite a bit of policy attention by policymakers to essentially mitigate those risks and to reinvigorate growth, but perhaps also to support creation of jobs as a means to essentially achieve China's goal of achieving common prosperity. Now, briefly, what we saw in terms of policy, macroeconomic policies last year, there we see that both fiscal and monetary policies have supported growth in the context of essentially weak performance. We're showing here the fiscal deficit, the augmented fiscal deficit, which combines the headline budget deficit with several off-budgetary accounts. Up until November, you can see that essentially fiscal activity or fiscal support was similar in magnitude to what we saw in 2020. We expect this augmented deficit for the full year to be around 7.4% of GDP, so a quite significant support from the fiscal side, mostly in the form of tax, various tax measures, tax deferrals, and tax rebates, as well as public infrastructure investment. Now, despite this fairly sizable fiscal support, the impact on the economy was relatively muted, and that's largely due, and this is what we show here on the right-hand side, these are estimates that our team prepared of the fiscal multiplier. So this is the impact fiscal spending has on ultimately growth. And you can see we compare here the pre-pandemic period where a fiscal multiplier was close to 90. It's slowed down markedly, and I think our conjecture is here that this is largely due to mobility restrictions that have affected essentially broader economic activity and confidence, and therefore the impact of fiscal spending on broader investment and economic activity in the economy has been dampened and therefore not been able to fully offset the decline, the weakening in domestic demand. Similarly, on the monetary front, we saw throughout the year a moderate easing of monetary policy with some modest rate cuts in key policy rates. However, as you can see from the right-hand side chart here, especially household demand, credit demand has been subdued, especially for mortgages. And that's, of course, directly related to what I spoke about with regard to the housing market and property sector, where consumer confidence and sales hence are down, and therefore credit demand has also been weak despite steps to ease monetary policy. Again, muting the impact this monetary policy support and accommodation had on growth. Now, towards the end of the year, and this leads towards sort of talking about what we expect for this year, we saw that policies have pivoted towards a more pro-growth stance for 2023. And I would argue this is true across several areas of policy, and including, of course, COVID-19 related public health policies, with the effective rollback of China's zero COVID policy in a relatively short period of time. It's true for the policies and regulatory steps in the property sector, where previous policies, regulations, the three red lines that were intended to curtail leverage in the sector have effectively been rolled back and replaced by policy support. Regulatory reform, in particular, the regulation of platform firms, where we do see some signals that after essentially 2 years of regulatory scrutiny, there is now a bit easier regulatory environment there. And then macroeconomic policies are also expected, at least from what we take from the Central Economic Work Conference in December, the signals point to continued support into 2023. Now, what is important here, and we've kind of tried to compare here how these policies have evolved over the last 4 years, and you can see that in the last 3 years up until last year, these policies in a way acted against each other, or in some cases combined in a way that dampened economic activity. And 2023 perhaps will be the first year where these policies are essentially broadly aligned to support a recovery. Now, with that, what we expect is, as Ayhan and also Hassan mentioned, we expect growth for China this year to recover to 4.3%, so quite significantly above both the average growth in the global economy and the average growth among emerging markets and developing economies. As such, China's economy is expected to contribute positively and more significantly than last year to the overall global growth and economic activity this year. Much of that will be led by recovery of domestic demand, with both consumption expected to recover and especially pent-up demand to be released as these restrictions have been rolled back, especially after the first quarter and after the first wave of COVID-19 infections is going to subside and consumers really regain confidence. Investment is also expected to recover, in part because the real estate sector and investment in housing and property is expected to, as I mentioned earlier, to have bottomed out and to recover at least modestly this year, and to be less of a drag on overall investment activity. And then on top of that, we expect that also public sector and infrastructure investment will continue due to essentially continued policy support from the fiscal side. And then manufacturing investment hopefully will also remain relatively resilient and recover modestly after several years of basically subdued activity there. Now, offsetting that positive momentum on the domestic side is an expected decline in external demand against the backdrop of basically the context and dynamics that outlook that Ayhan presented on the global economy, where outside of China, all major economies developing and advanced economies are expected to slow down markedly next year, and that will of course weigh on the export-oriented manufacturing sector in China. Now, as in the case of the global economy, China's outlook is subject to several risks, both domestic and external. I think on the domestic side, a key uncertainty relates to the pandemic trajectory. We know that the rapid dismantling of COVID-related containment measures was accompanied by an equally rapid escalation of infections. But of course, the question is what will happen after the first wave subsides and for the rest of the year, and to what extent COVID-related disruptions will continue to weigh on activity for the remainder of the year. There's some uncertainty on policies with regard to the regulatory pivot towards a more pro-growth and pro-business stance, as well as to the perhaps not the direction of macroeconomic policy support, but the magnitude of that support, so that budget numbers, for example, will only be released in March. So we will only then see to what extent fiscal policies, for example, will continue to support growth and what magnitude of support can be expected. Now, on the external side, I don't think I need to spend much time because Ayhan already elaborated the multiple interconnected risks that face the global economy and outlook. Key, of course, is a risk of a global recession in the near term, and then perhaps more in the medium term, the risk of geoeconomic fragmentation and tensions that could, in the short run, actually weigh on investor sentiment and investment activity, and in the longer run, lead to a slower potential growth by weighing on productivity growth. And China, of course, I don't need to say much on that, is in the center of that risk, given its very prominent position in key global value chains. So that's a key risk in the global economy that could likely affect China's not just near-term outlook, but even medium-term growth prospects. Now, to the final message around policy priorities, and here again, some of this nicely resonates and echoes things that Ayhan presented in his presentation. But for China, of course, public health-related policies remain important to ensure a safer reopening that would be also less disruptive to economic activity, including through vaccination of vulnerable groups, effective case management and treatment. On the macroeconomic side, I think clearly with the economy expected to remain below potential this year, despite the expected recovery, there is a case for continued fiscal support, and China certainly has policy space to undertake such support or to provide such support, but redirecting that support from investment and support to enterprises, meaning tax cuts and tax measures, towards support to consumption and household, would not just support a short-term recovery in demand, but also contribute to the sort of more medium-term rebalancing of the economy towards a more consumption-led growth model. On the monetary side, again, there is a case for continued monetary accommodation, given that especially core inflation remains relatively subdued in the case of China. But of course, policymakers will have to be vigilant and at the same time balance policy support to the recovery with the need to contain financial risks, given especially China's fairly high leverage and overall debt levels. And finally, in the property sector, following the positive steps in terms of providing liquidity support and lowering down payment requirements and mortgage rates to support demand, there is perhaps a need for more decisive action and additional action to protect home buyers by increasing the funding to enable completion of troubled projects and to enable a market-based restructuring of key corporates, which is essentially key to rebuilding confidence of home buyers in the sector. And then finally, the last group of policies aim more into the medium-term structural reforms to bolster China's potential growth. And that includes well-known priorities around a predictable regulatory environment, further quality opening up in line with the commitments the authorities recently reinforced including in the Central Economic Work Conference in December, and to create a level playing field between private sector enterprises, foreign and domestic, and the state-owned sector. Secondly, strengthening of social security, safety nets, both as a matter of social policy to mitigate risks and shocks and the impacts of shocks on the most vulnerable, but also to bolster essentially or support the rebalancing of the economy towards a more consumption-led growth model. And then finally, catalyzing the transition towards a greener growth model through the application of market-based instruments and pricing using China's existing emissions trading scheme that was launched last year, and public investment in climate-smart infrastructure, where again, of course, additional stimulus measures would offer an opportunity not just to support a short-term recovery, but also contribute to a medium-term objective of the authorities to move towards a more low carbon and climate resilient economy. With that, I would like to thank you very much. And like in the case of Ayhan, I would very much encourage you to check out the China Economic Update called Navigating Uncertainty that we launched in December, and that you can find on our website. Thank you very much, and back over to you.
Thank you so much, Sebastian, for excellent summarize on some key perspectives. I definitely in full agreement with your perspective. If I look at how China, as we reopen from this COVID-19, how we can make sure senior people and the elderly group take a vaccination, and how we should be able to take the structure approach, right, to boost domestic consumptions, where also increase export, support to other economies. I look at that, definitely we need to be very consciously aware how we should build a much stronger economic foundation, be able to sustain the growth momentum in a number of years, right? Thank you again for excellent perspective, how we are looking into 2023 in China economy. Now, let me go back to, I have received some questions from my media friends, yeah. Maybe I share some questions, and then I would like to invite our experts from World Bank and to pick up questions you feel comfortable to address. The first question I received is, can you briefly describe the basis for this economic outlook report? Is there any data or phenomenon in this recession that can be seen as historically repeating, and which ones are new?
Thank you, Mike. obviously, we have been witnessing historic developments. The pandemic was one historic episode that basically led to this record decline in global GDP. When we look all the way back to 1930s, we see that type of collapse in output. Then, of course, in the initial stages of the pandemic, we saw collapse in inflation, and then inflation rebounded with activity coming back, and we saw a sharp acceleration in activity in 2021, but that came with a kind of a sharp increase in global inflation, especially inflation in advanced economies. Now, what we are seeing since 2021, after this sharp rebound, sharp slowdown in activity. And this year, as I mentioned, we are going to witness 1.7% growth according to our forecast. Obviously, there is considerable uncertainty around this forecast. There are some upside risks. China can surprise, of course, Sebastian mentioned, especially in the second half of the year, but there is a menu of downside risk as well. If we have another global recession in 2023, that will be truly historical. It will be the first time global economy basically experiences two recessions within the same decade since the 1930s. I think that the historical parallels are there. The hope is that the global economy will weather the storm and transition to a higher growth, lower inflation path in 2024. But let me stop there. Back to you, Mike.
Thank you so much. That's a very good summary and a very good perspective. Yeah, thank you so much, Dr. Kosi. The second question I received is many Silicon Valley technology giants, including Twitter, including Meta, experienced large-scale layoffs in 2022. Could this be a sign of a global recession? And what are some warning signs for a global economy as well as public and private investments? Anyone?
Eka, you want to take this one, or you want me to answer?
As you wish, Ayhan. Maybe you answer because it's about the global recession, signs of global recession.
Yeah, so it's indeed true that we see these companies, especially in tech industry, announcing large-scale layoffs. And the issue is that in the United States, labor market is still quite robust. When you look at unemployment rate nationwide, you see it's still at its historical lows. So the global recession challenge will be there if we continue seeing financing conditions tightening. There is a significant decline in confidence and, of course, financial stress in some parts of the world. In an environment, we see a record amount of debt on public entities as well as private entities. Now, there are warning signs in the context of these large-scale layoffs. There are warning signs in the context of what major investment banks are doing in terms of how they are increasing their capital buffers, seeing the kind of the potential declines in revenues and possible bankruptcies. So it's a difficult environment for public as well as private entities. And given the inflation challenge, in all likelihood, we will see labor markets cooling further in the United States. Unemployment rate is rising. And the impact of tightening showing itself increasingly more visibly. We know that monetary policy impact takes time to be seen on the street, but given the lag and given the kind of the 8 to 16 months lag, the monetary policy affects activity, we will see it more this year than what we have seen so far. For us, we think that the US economy will deliver growth around 0.5% this year. We do not see a recession for the entire year, even though there could be a mild contraction in the US. In the euro area as well, we see growth flat, zero, but we do not see euro area contracting for the entire year. Back to you, Mike.
Thank you so much. I look at that's the balanced perspective, how we look at the financial policy along as well as those the changes with the technology players, right? How we can have a continuously boost in the economy to boost the confidence for the economy or society to be able to sustain the momentum. Yeah, that's very good. The third question I have is given the geopolitical turmoil and the import barriers, is there a regionalization of a trade take place? Is a trade cooperation and agreement the way to bridge a global value chain? How can China contribute to the process? Maybe I look at the Hassan or Sebastian or the Katrina, and three of you can offer your perspective.
Sure, I'm happy to make a start on this conversation. I think the jury is still out there on that question. I think in many sectors, there are long-established global value chains. And the evidence really, when we analyze many sectors, is that many of these value chains, global value chains, remain intact. Now, there is certainly some diversification and a search that many companies and buyers have for market diversification. And so therefore, for instance, Vietnam is a country which has certainly benefited from the fact that there are several firms who would like to be able to source from multiple countries. Mexico is also another country which has benefited. And at the same time, there are certainly protectionist measures that have been introduced through various pieces of major legislation in all over the world. And that, for instance, in the market for electric vehicles, that is certainly causing some shifts in the US, for instance, in terms of, where, say, batteries are sourced and the incentives for that as well. So overall, we see some signs, but I don't think we can generalize and say that right now we have the evidence to say there's been a major shift in existing global value chains. But I would invite my colleagues to either confirm or contradict me if they wish. So over to you, Sebastian, if you want to add anything.
I mean, maybe on the second part of the question, on what China can do in this context, I think in many ways it reinforces the priority of the opening up through, liberalizing some of the sectors that continue to be subject to restrictions, especially service sectors where China is considerably less open, alongside many other countries in Asia than on the goods side. And of course, also leveraging regional and trade agreements like the RCEP to essentially lower trade barriers and improve market access across the region. I think those are perhaps some steps that can be taken in this context. But let me stop there. Thank you.
Yeah, so I can jump in and just continue. As Hassan said, this is still unclear, right? There were trends of more regionalization, which increased regional trade in around 12 to 16. But then we have seen actually, despite the expected more regionalization, we have seen more globalization over the past years. And especially Asia's role has increased because of this production hub and because of competitiveness. So in that sense, also, I think first of all, there are three reasons why perhaps there will be some regionalization, but still globalization will continue to be the major trend. As some reports and some studies show, there's already very high regionalization in the world. And this is more than expected by some modeling results. So in that sense, the room for more regionalization perhaps is limited. The second, especially in this short term, what we will observe is that there is still a huge push for companies to go for more because of high inflation and input shortages, and because of high competitive pressures, there's still need to supply the essential materials. And that is something which is pushing still the long distance trade. Kind of to cut it short, the point for policymakers should be, I think, considered as follows. There are short-term trends, and those can be managed by better supplies, inventories. But in longer term, of course, what is the most essential is whatever helps productivity and investment. And in that sense, clearly the companies and the countries should focus on clearly more openness of supplies in countries where services, trade restrictions to open up to increase and boost productivity. And I think this is the most important, I think, for policymakers, specifically on China. I want to mention that actually, in contrast to what was expected, China has not been contributing largely to global and regional trade over the last year, especially because of this domestic weakness. And in that sense, I think one development that we are all looking forward is that when China opens up, and then there will be more boost of domestic demand, this will help and offset some of the weakness of global trade, which is expected in 23 from advanced economies and other emerging market economies. So that's what I wanted to add. Thank you.
Thank you so much. I think that's a great perspective. On the one hand, we are still not out the woods yet. We still see a lot of uncertainty and challenges. On the other side, as we look into this post-pandemic, what are things to do? What are some right things for policymakers to advocate and to promote the openness as well as boost the economy, which will be substantial to give a strong boost to the world economy. So as we approach to the end of the session, I would like to invite each of you to give a one sentence, your personal expectation, how you look into 2023, what the things you want to share with the audience. Maybe Dr. Kosi, we start from you.
So my personal hope from 2023 is a little bit of, decline in volatility, given what we have seen over the past now 3 years, lower frequency of shocks, moderate growth, and lower inflation. And I'm hoping that the global community will get together, work better, work intensively to address broader problems. Once again, thank you, Mike. It's great to have this collaboration with Center for China and Globalization, and I look forward to the next episode of this tradition. Back to you. Thanks.
Thank you. Maybe Hassan, over to you.
Thank you once again. I think there's the question of hope, and then there's the question of expectation. And I think Ayan said many good things about what we would hope for. I think his report is very clear in terms of what we expect, which the one thing that I would like to highlight is one statistic in the report which shows that per capita incomes in Africa and in particular will be per capita income growth will essentially be close to zero in 2023. And whilst I'm the regional director for East Asia, whilst the colleagues on this call cover East Asia and the globe, that is the one region in the world that I feel that as part of the development community, we need to focus on. We need to focus on that statistic, what that then implies for domestic policies, of course, in countries in Africa, but also global investment trends, and also the relationships between the large geopolitical actors and that continent as well. So that's one thing I would like to provide as a takeaway that other audience members may want to look at and think through from these long and many interesting sets of data that were presented. Once again, thank you from my behalf as well to you, and look forward to continuing this collaboration with the Center for China and Globalization. Thank you once again.
Thank you so much. Maybe now invite Katerina, you share your personal hope or expectation, what the things you see in 2023.
Yes, so thank you, Mike, again very much for one more time organizing this meeting. It was a pleasure listening to the presentations and talking and engaging with the audience. In terms of the expectations, I think, as also Hassan highlighted, the JEP, this report, and also the other East Asian reports and China economic update, they all have this baseline. So what we really hope that the baseline will materialize and our forecast will be as expected, right? And then, as also everybody alluded to, clearly, like, more hope is that if our high case scenario materializes, what it means for the world is that there will be no recession. And what means for East Asia clearly is that, first of all, East Asia will back the trend in terms of China, right? Accelerating next year and developing as expected. And that's supporting some offsetting, right? Playing as an offsetting role for other East Asian regions, especially for small countries, Pacific economies, like Ayhan discussed about small countries, which have been mostly, like, very strongly damaged by the pandemic, and where the tourism recovery will bring hope for next year. So that is our hope for a higher case to materialize. So clearly a little bit of hope is also that less tensions geopolitically, and that's personally also from my side, because I come from that region where there is a war. So I really hope that we will see resolution of that going forward. Thank you.
Thank you. Sebastian?
Thank you very much, Mike, also for the opportunity and this very engaging conversation on the global economy and on China. Now, let me focus my remarks on the economy, on China's economy, and echoing a little bit what my colleague said. I hope on the upside that the year of the rabbit will mark even higher growth than what we are projecting in our baseline, supported by policies to basically manage public health impacts of the pandemic here in China, and to support economic activity, not just in the short run, but also to lay the foundation for sustainable growth, for more rebalancing from investment towards consumption, for a more equal distribution of the benefits of growth, benefiting also some of the parts of the country that are still lagging, and a recovery that is greener, in the sense that it's channeling resources into low carbon investments that will help achieve China's goals of peaking carbon emissions in 2030 and achieving carbon neutrality by 2060. And then I hope also that on the downside, that some of the risks that we outlined, both domestically and globally, that those will be managed effectively, both at the national level. But I think, as Ayhan shared in his presentation, there's also ample scope for global collective action on many of the problems that we face and that are shared across countries, and where there are lots of possibilities for potential benefits, and especially China is the second largest economy, of course, has a big role to play in this regard. Let me stop there. Thank you very much again.
Thank you so much. I think this has been a phenomenon important, and also we are in a very critical conjunction as we put a stop to last 3 years pandemic. This is in human history is the first time we try to restart our life, our society, our business. I look at this just 1 hour. It's not only to share the economic or monetary policies, but also World Bank Bureau report has expressed a hope and a new hope in 2023, how we should not only look for the short term, how we can boost the economy, even like the tourism and money expenditure in property market, domestic consumption, export. Those things will inject the new hope or energy into this recovering world. I look at that's very important for the human. On the other side, also we should not lose a sight on some structures, challenges, and how we should be able to sustain the economy in good hands of the world, as well as create a perspective, I would say the prosperity for the society. I think that will be very crucial. Thank you so much for your trust and the partnership with the World Bank. Definitely, I look at as China, we are opening up. I look forward to, on behalf of CCG, to welcoming all of you to visit us here in China, and look forward to see you soon. Thank you so much.
Thank you, Mike. See you.
Thank you so much. Happy 2023.
Thank you very much.